So a year ago, we communicated to you guys that we're concerned about global valuations. The US is running full tilt. Investors were confident that nothing could go wrong, slightly complacent. That worried us. That's not the environment that normally brings good returns. Standing here 12 months later, we've had a tough year. We've seen a lot of turmoil in markets, but we're significantly more excited about what we see. Now, that's not a blanket statement in terms of global equities are cheap. That we don't view it as that. And there are certain parts of the market that are still very expensive. So if we look at the Schiller PE in the US, so the Schiller PE is a cyclically adjusted price to earnings ratio, and we take it back more than 100 years, we can see it's only been more expensive on that basis twice. Dot-com bubble and just before the Great Recession. Now, this worries us. Now, this is obviously the market as a whole, so they're very expensive stocks, very popular tech stocks in there, but it still bears mentioning and comparison. The PE ratio obviously has a second dynamic in terms of the E, where profits are. This also concerns us. If we look at the margin on the S&P 500, and we take it back almost 20 years, the average is 8.2. The last 2.5 years, it's gone from average to 12%. So not only is there a risk that the price is high, but there's also, in our view, a risk that margins are high. So if we look at a scenario where margins start coming down, and the prices start coming down, the multiple contracts, investors could be in for a rocky road. The disconnect between expensive and cheap is what excites us. If you look at this chart going back to the 50s, the gap between expensive and cheap, the last time the gap was this wide was .com in 2000, and we all know how that turned out. So we just referencing that the gap has become so wide, and those cheap stocks, that's where we kind of looking around. We're not buying all of them. Some of them we don't think are worth buying, but there are some that we think have just been tossed out with the rest for various reasons. They don't find favor with investors at this point, and we're looking for the underappreciated quality. So the top ones one could talk about are crowd. They're popular. Okay, so if we look at crowding, crowding is a mathematical calculation that is used to explain where everyone is going. What is being bought, what is being recommended as buying opportunities, what's doing well. It's exactly what it says. It's the crowded trade. It's where everyone wants to be. So if we take globally, now this is not just the US, we break it down by sector, we look at where it's popular to be. Healthcare, tech, this type of thing, it's very popular. Everyone's saying buy it, it's done well, it's got a lot of momentum, it's in every fund. Obviously this references globally. And we think there's a risk because they are priced for that to continue, and it could continue, we don't know. But if it doesn't continue, we could have a situation whereby stocks are down, as we've seen, sometimes this happens. So we're fishing in these ponds. It might feel very uncool, unsexy, unpopular right now, and we're not buying all of them, but that's where we're fishing. Just to give you a couple of opportunities that we see, companies you might or might not know, but just give you a sense of those unpopular places that we're fishing in, what we're finding. One company, and these you'll see in the Global Flexible top 10, is Babcock. It's an engineering company. It runs the shipyards in the UK and so on. It's got the submarines and the naval vessels coming through there. They maintain them. They've done it for more than 100 years, very successfully. It's a very good company. It's got a long, dependable cash flow stream, but it's unpopular at the moment. It's unpopular because of Brexit. It's unpopular because it's got pound revenues. It's unpopular because it has exposure to the UK government. We don't know what's going to happen there. What we do know is it's on a 7 PE and 11% free cash yield, 5% dividend yield in a currency that is arguably cheaper than the dollar. So we think there's an opportunity here. We don't think 10 years from today Brexit will still be with us. We think this business will be around for another 100 years, still running the shipyards. It's just that investors are not confident on it right now, and our work suggests we're getting it very cheap. Another one, this is a Fortune 500 US company. It's the biggest or largest producer of potash and phosphates globally. Now, we like the supply side dynamics of fertilizers. We think the demand side will take care of itself. Arable land's going down, global populations are rising, fertilizer is going to be key in our view. That's long term. Short term, we believe the prices are low and the market's not giving Mosaic any benefit of a better outlook. We believe we're getting it significantly below what it should be worth in a normal environment for a business that has got a long-term outlook in terms of demand. Japan Post Insurance. Why Japan? I mean, so the Japanese, they love their post offices, 20,000 post offices. These guys sell the life insurance and medical gap cover through those post offices. It's a very good business, it's very profitable. It's the oldest population in the world. More than a third of them are older than 65. Medical gap cover becomes very important to them. It's very profitable. It was privatized in 2007, which means it's now standing on its own feet. It was only listed in 2015. So our view is it's cheap because the market is underappreciating the opportunity and also ignoring it. It's not in the indices, the trackers aren't buying it, the stockbrokers aren't punting it. It's new. So our work suggests that here's a key opportunity.